Let's rewind to 1985. You decide to put some money in the stock market, and for a couple of years, everything goes your way. Your portfolio keeps climbing, and you feel like a financial genius. Then comes the Monday Massacre. Wall Street suffers its biggest one-day drop in history. Panic sets in, and your friends start urging you to sell everything before you lose it all. But you hold on. The market slowly recovers, right up until the tech bubble bursts. The Nasdaq goes into absolute freefall, and those same friends are on their knees begging you to take your profits and run. Decades later, just as you're feeling secure again, the global economy completely shuts down. The streets empty out, and the market braces for the worst economic contraction since the Great Depression. Living through just one of these events is enough to rattle a seasoned professional. Enduring them back to back makes the idea of perfectly timing when to buy or sell feel entirely impossible. Every time the market plummets, the headlines scream at you to pull your money out. Human nature tells us to run from the burning building. But what happens if you just sit on your hands? What if you ignore the talking heads, keep your money exactly where it is, and endure every single one of those historic disasters? This chart tracks the stock market from 1985 to the present day. If you look past those terrifying drops, you'll see a clear, undeniable trajectory. Despite a major crash happening every decade, the market returned an average of 11.23% per year over this timeline. That average return completely changes the math on your wealth. If you had invested a steady $250 every month across this exact timeline, your portfolio would have grown to over $1.8 million. Building long-term wealth relies on emotional discipline. Historical data suggests that an investor's reaction to a crash is far more consequential than the crash itself. Trying to pick the next Tesla or day trading meme stocks requires poring over income statements, tracking price charts, and guessing what the crowd will do next. It is incredibly stressful, and most people fail at it. Instead of trying to find the needle in the haystack, you can just buy the haystack. That's the logic behind an index fund like the S&P 500, which bundles together the 500 largest public companies in the United States. Think of this chart like the top 40 music rankings on Spotify or the radio. The tracks with the most sales move to the top of the list, transforming into top-tier companies like Apple, Amazon, and Google. If a song loses popularity, it drops off the charts entirely, and a new hit takes its place. The S&P 500 works exactly the same way. If a major company starts to fail, it simply gets booted from the index, and a rising competitor automatically takes its slot. You don't have to lift a finger. Index funds eliminate the need to gamble on which specific bands stay famous. It's a mathematical bet that the world will keep listening to music. Before putting a single cent into the market, you need a cash buffer. An emergency fund covering 3 to 5 months of living expenses ensures you never sell your investments at a loss just to fix a broken car. Next, you need a container for your money. Choosing a tax-advantaged account, like a stocks and shares ISA in the UK or a Roth IRA in the United States, means you legally shield your future profits from capital gains tax. Then you start small and automate. You don't need a huge lump sum to begin. By simply setting an app to invest £5 into the S&P 500 every day, roughly the cost of a daily coffee, you start consistently buying the broader market. When you select your fund, look closely at the fine print. You'll usually see an option between distribution and accumulation. Always choose accumulation. This ensures that any dividends those companies pay out are automatically reinvested into buying more stock. By shielding your money from taxes, automating your daily deposits, and setting your dividends to reinvest, you effectively fire yourself from the daily job. You have completely removed human error and built a self-sustaining financial engine. Let's look at this chart to see exactly what that engine produces over the long haul. If you invest just £250 a month for 31 years, you will only put in £94,000 of your own money, but your total portfolio value will sit at $1.14 million. If we extend that timeline out to 40 years, the results scale aggressively. Your principal cash barely ticks up, but that portfolio bar skyrockets to $3.56 million. At this point, skeptics usually point to inflation. They argue that millions of dollars won't carry the same purchasing power 4 decades from now. And they're right. Keeping your money idle in a bank account guarantees that inflation will slowly eat away its value year after year. Consistent market investment serves as an essential hedge, protecting your future purchasing power from the inevitable effects of inflation. There's one variable in this equation that dictates your final result more than any other. The most powerful factor is the length of time you wait to begin, far outweighing the specific fund you choose. Look at these two growth curves. This tracks someone who starts their automated system at age 25 versus someone who decides to hold off and wait until age 35 to begin. Compound interest doesn't care about fairness, it cares about time. Because the math leans so heavily on your earliest deposits, sacrificing that first decade hollows out the exponential growth at the very end. Generating wealth relies on maximizing time, rather than picking a perfect stock or predicting the next crisis. You just need to buy the market, set it on autopilot, and give it the time it needs to grow.